Alexandra Readhead has arrived. She
Hi,
is from
everyone.
the Institute of, what is it? The International Institute of Sustainable Development, I think. And deserves the hero medal of the whole seminar for joining us at such an ungodly hour. She's 12 hours away from us in Perth, in Australia. I think that is right. Isn't it 12 hours? So it's
You're right, yeah.
4:47, just like here, except it's in the morning rather than in the evening. So we are deeply, deeply grateful that you are sharing your wisdom with us at such a time. And if it's any consolation, I will do the same thing tomorrow in Korea. So, okay.
Thank you, Thomas.
Over to
Thank you,
you.
Christian.
And I've made you co-host, and you can share the screen if you like.
Perfect. I will do just that. Hopefully you can see.
There we go.
See my slides? Yeah, great.
Yep.
Thank you, Thomas. Thank you, Christian, for the invitation. Once again, it's a pleasure to be with all of you. One day we will be together in person, hopefully not too far away. And it's really nice to meet all of you virtually. As Thomas said, my name is Alexandra. People call me Ali Readhead, and I work for the International Institute for Sustainable Development, which hosts the Intergovernmental Forum on Mining, Minerals, Metals and Sustainable Development, which is an intergovernmental agency that exists to represent governments of mining countries. So we have 76 member governments, many of who are governments of developing countries. So I lead our work there on tax and extractive industries, and it's really nice to be with you all. As Thomas said, it is quite early here, so if I say things that might sound confusing, it's probably because I'm confused because it's early. So feel free to ask questions or make comments as we go along. But I'm going to speak for about 20 minutes, and then I'm looking forward to hearing from all of you. So I'm going to talk today about international tax and the mining sector, but I'm going to talk about those issues in relation to some new work that we're doing at the IGF on the future of resource taxation, which I hope you will find interesting. So the way I am, I guess, conceptualizing mining taxation or extractive industry taxation these days is in terms of the past, the present, and where I hope the future will lead us. So when I talk about the past in terms of mining taxation, really what I'm talking about here is the dominant tax system for mining. So as you know, I'm sure many of you are aware, we've been mining minerals and metals for hundreds of years, and in many instances, the way that governments benefit financially from the extraction of their natural resources hasn't changed a great deal over a long period of time, and that was largely born out of a kind of colonial model, particularly in developing countries, a colonial model where colonial powers would pay developing countries a fixed fee per unit or per ton of the mineral that was extracted. So it started with a kind of unit-based sort of tax system that was, had no relationship to profitability, and of course it meant that the individuals or the entities that were extracting those resources were making huge profits. And then over time, government started to introduce value-based royalties. So instead of just charging fixed fee per unit or per ton of the mineral, they started to charge a royalty on production that was based on the value of the resource. So 5%, 10% of the value of what was extracted, which was a way of trying to increase government's share from their natural resources. And then eventually corporate income tax was introduced, again to try and ensure that government also benefited from the profits from the extraction of their natural resources rather than just getting that fixed fee. And it's evolved over time, but really it hasn't changed a great deal since then. So what you can see on the screen here is the dominant tax system for mining, which is, around the world, there's going to be variations from one country to the next, but the building blocks of the mining tax system are the same. And that is a royalty on production. So 5%, between 2%, 6% of the value of the mineral produced on gross. So I put here 5%. Corporate income tax, which is your standard tax on business income, perhaps with some variations in terms of how quickly you can depreciate your assets, how long you can carry forward tax losses, and then 10% free state equity. So this is becoming more common now. We're seeing governments that are requiring free equity, so a share of the positive cash flows of the project without any paying for any of the costs associated with that shareholding. So this is the kind of dominant tax system that we see in most countries. As I said, the rates might change, but these are the basic building blocks. And what that is meant to deliver, as you can see, is that the primary share of government revenues are anticipated to come through corporate income tax. So it's corporate income tax that are really intended to drive government revenue collection. Royalties, the tax on production, the 5%, that's important. And often people say, but royalties are much more important in mining than income tax. And yes, they're important because of the purpose that they play, which is to compensate government for the sale of a non-renewable resource. But actually, in terms of revenue collection, based on kind of our theoretical models, royalties are meant to play a less significant role compared to corporate income tax in terms of delivering revenue for the government. So this is an ex-ante modeling, right? So this doesn't take into account what happens next in terms of the ability to collect these taxes and of course their robustness to profit shifting, which is where the international tax issues come in. So if we were to just design the system from scratch and to look at which instrument was intended to deliver what share or proportion of government revenues, it's really corporate income tax that government of resource-rich countries are depending on. So unsurprisingly, and perhaps this is very clear to many of you, is that for a long time now, government takes, so how much government gets from the mining sector has not been meeting expectations. And this is a growing problem, particularly in developing countries, obviously, where public finances are especially constrained. But that's for potentially a few reasons that the government take from mining might not be meeting expectations. So on the one hand, you've got tax incentives, which have been a big challenge in the mining sector, is that many countries have given tax incentives to try and induce or attract mining investment, despite the fact this is a location-specific industry, so you can't pick up the mine and move it to another country. Despite that, governments still continue to give out tax incentives, often very wasteful tax incentives in the form of tax holidays. And this has been an issue for revenue collection, is that in particular, one of the things that we have in the extractive sector, which is perhaps more unique, is the prevalence of concession agreements or contracts between the investor and the state that tend to set out the specific fiscal terms that apply to that project. And often those contracts contain tax incentives. And those tax incentives might also be subject to fiscal stability clauses, which basically means they're frozen, they're locked in perpetuity. So even if, 10 years later, the government realizes, wow, we've really given up way too much revenue as a result of these incentives, it may be very difficult for them to unwind those incentives. BEPS, so base erosion and profit shifting. So the mining sector is dominated by multinational companies. Large-scale mining, at least, is dominated by multinational companies, which means that the opportunities for cross-border tax planning are significant. The example on the screen is just a very simple depiction of a transfer pricing arrangement where the mine is selling its mineral product to a related party, often in a low-tax jurisdiction, who then on-sells the product to a third party at the full market price. So the first sale takes place at a below market rate, and then the product is then on-sold at the market rate, and that profit accumulates in the low tax country or with the related party. So this is a very common way that we see multinational companies stripping profit out of the resource-rich country. So there's a range of kind of tax planning issues, BEPS issues, whatever you want to call them, that are relevant to the extractive sector and often play quite a significant role or have an outsized impact because of the prevalence of multinational companies in this sector, but also the scale of the investment involved. Then we have governance issues. So you can see on the screen the chart that contrasts governance in resource-rich versus non-resource rich countries. So there's enormous challenges with governance of this sector and a lack of transparency, although that's obviously improved significantly in terms of contract disclosure in recent years, but still there's issues with special deals for certain investors and kickbacks to corrupt government officials. So this is still an issue in terms of management of the resource and the revenues that flow from the resource. And lastly, capacity. So I spend a lot of time working with tax administrations to build their knowledge of the sector, because this is quite a specialized sector and they might not have sufficient knowledge and expertise to really be able to detect issues of BEPS in the mining sector and then to evaluate and do something about that. So these are some of the reasons that I think the government take is not meeting expectations. Of course, I'm sure there are many others, and you may have thoughts on what these are as well, but these are just a few. The other point that I want to highlight is I am speaking largely about mining, because I think mining, which is what we might call hard rock minerals, things like copper, gold, silver, etc. Mining is quite different from oil and gas. Yes, they're all extractive industries, they're all non-renewable resources, but they do have quite different features, but also the way that governments tax these resources is very different. And what you can see on the screen is a snapshot of a new study that we've done, looking at 28 countries and basically looking at average government revenues as a percentage of the value of exports per sector. So we've taken the value of minerals exported, the value of oil and gas, and worked out how much revenue government is collecting as a proportion of the value of those exports, to give us a rough idea of whether or not we think it seems reasonable or not. This is a very kind of back of the envelope kind of calculation, but it's one measure that we can look to. And what you see is that typically governments collect a much higher proportion of the value of their exports from oil and gas than they do minerals. And this is particularly pronounced in Africa. And the reason why I want to focus on that region is because the interesting thing is that these mining and oil are taxed very differently, particularly in Africa, or it's very kind of stark. And the dominant tax system that I described at the start, which is this kind of focus on corporate income tax and a royalty, that is exclusively the system that's applied to minerals in African countries, right? As I said, the rates might change, but that's the system of taxation. In oil and gas, we have a multiplicity of approaches, but in Africa in particular, we have what's called production sharing contracts. And production sharing contracts simply mean that basically the government is taking a share of physical production of the oil in lieu of taxes and royalties. So that is very different because obviously production, how many barrels of oil you produce is physically observable. It's much easier to monitor and to verify than it is a tax on profits, which is very easy for companies to manipulate. So these mining and oil and gas are kind of governed by two very different fiscal regimes. And so I think it's very interesting that they deliver very different results in terms of government take. Now, there may be many explanations for this. I'm not saying that it is the fiscal regime that is necessarily the answer. There are other features. Oil and gas is often much more profitable than mining, but it is striking the order of magnitude difference and the fact that these sectors have very different fiscal regimes. To some of the international tax issues, just to kind of expand on that. So, mining is vulnerable to a range of cross-border tax planning issues similar to other sectors. I think just to highlight a few of those, so this is what we would regard as the mining value chain, from when you acquire a resource all the way through to when you sell the mineral. And there's going to be international tax issues that arise along that value chain. that will be of concern for governments, and these are some of the issues that I focus on in my day-to-day work. So some examples of that, you have the offshore indirect sale of licenses, potentially at the exploration stage. So an example from Uganda was a case with Heritage Oil, where they basically restructured their investment using a tax treaty to avoid paying any capital gains tax on the sale of their license, which was about $400 million worth of capital gains tax, which Uganda was able to recover. Yay, Uganda. But it was certainly, a big issue and a very drawn out legal process. And you also have the example of interest deductions, so excessive interest deductions. So this is a particular issue for the extractive sector, just because of the scale of the investment. We're talking about huge amounts of money that are being sunk into these projects, and often through related party debt. So an example from Australia was a case with Chevron, where they structured their loan through related party in Delaware, which meant that they were paying a hugely inflated interest rate on that debt as a way of stripping profit out of the project in Australia. And so that was, again, about $400 million US. A case that I've been involved in that's now public in Mongolia, involving intragroup services, so the provision of management services by a mining company to a project in Mongolia. So that's was about $288 million that's just been recovered by the Mongolian tax administration. So there's a range of these sorts of international tax issues along the value chain, and of course there might be ways of addressing each of these issues from a legal and a policy and a capacity standpoint, but it often feels like we're just trying to really plug gaps or holes in what is a very leaky bucket. And I think in the extractive sector, these issues take on even greater significance because we're dealing with a finite non-renewable resource. So once the resource is extracted and shipped out of the country, that's it, it's gone. Your chance to tax it, it doesn't come around again like normal, perhaps, businesses. And because this is also a publicly owned asset. So from a philosophical point of view, this is very different to ordinary business taxation. This is something that's publicly owned. It's a national asset, and so the fact that we're losing revenue via these various cross-border tax planning arrangements is particularly concerning and a cause of huge controversy in the resource-rich countries, where citizens in particular feel that they're just not benefiting. So if I may, I now want to turn to kind of the present. So that's kind of, I guess, looking backwards at the system. Looking backwards at the system that we have in place until now, and some of the challenges that we see in terms of revenue collection. But what's changing? The international tax landscape is changing once again, but there's also changes in the sector itself and in society that we're reflecting on, or I'm reflecting on, that I think warrant a stock take or a rethink of how governments benefit financially from their resources. So just briefly on this, I think these are two aspects of two things that are changing in the sector itself. So the first is that we're undergoing this massive technological transition, and this is not unique to mining. This is across the economy. Is that we have moving to a more automated way of working and operating, and that's certainly true for mining as well. So we have, for example, in Mali, in Africa, they have the first fully automated mine in Mali. So there is no people on this mine site, and that has implications. It potentially makes mining safer because you're kind of taking people out of the equation, which is certainly important. It also has the potential to be greener, but it also means there's fewer lower skilled jobs at the mine site. And this is huge for developing countries because the typical value proposition for resource-rich countries is that when a mining company comes in, you're going to get taxes, you're going to get jobs, and maybe you'll get some infrastructure. Now, jobs are a huge part of the equation, especially from a political point of view. Politicians do not like to see jobs disappearing, being taken away. So the fact that we're seeing less low-skilled jobs at the mine site is a big deal, and it has big implications for payroll taxes, for indirect taxes, and it also creates new kind of profit shifting risks through the role of intellectual property, intangibles in this sector. But really, we need to rethink, we need to rebalance, we need to adjust for this change in the shared value paradigm in the sector. The second thing is around opportunities and challenges from low carbon minerals, because unlike oil and gas, which is definitely a sunset industry, it's on its way out. I think the kind of low prices that we saw last year, yes, COVID played a big part in that, but it's also kind of the long goodbye, I think, we hope, to oil and gas. And mining, on the other hand, is an industry of the future, because many of the minerals and metals that we need for renewable energy technologies come from mining. So lithium for batteries, copper, cobalt, etc. So there's a lot of new opportunities in the sector that mean that you're seeing countries that are trying now to chase prices, right? So DRC wants to have a very high royalty on cobalt. You're seeing countries like Chile perhaps not use fiscal policy, but try and encourage more of the value chain to take place in countries. So having deals with Samsung to produce batteries in Chile using their lithium and their copper, rather than kind of shipping the raw materials to China. So there's opportunities and challenges from low carbon minerals that we need to consider in the fiscal regime and in the way that governments benefit financially from the sector. The other two changes that I want to mention specifically in terms of international tax, and I think we shared a reading around the current digital tax reforms and what the implications are for the sector. And we've been monitoring this quite closely since that project started. Again, there's a lot in flux, and a view that we still haven't solved what we needed to via the BEPS project. What a surprise. There's also proposals for new taxing rights. We think that extractive should be carved out of that new taxing right, because it would transfer profits from the resource-rich country to the country where the goods end up, the market country, which would be inappropriate in our view. Then we've also got the proposal around a minimum effective tax rate, which is very exciting and interesting and should certainly apply to mining, and also has implications for existing tax incentives practices that we have in the sector. Is there going to be an opportunity for countries to unwind some of those tax incentives that they might have had, so as to not get penalized by Pillar 2 and the digital tax reforms that would see top-up tax being paid in the residence country? So all of this is happening, but for the most part, the extractive sector sits outside of this. It's special. It's different. It needs a separate process to review resource taxation. It's very difficult to try and address the challenges that we see in the resource sector through these kind of broader international processes. Lastly, the obvious one around additional financial pressures, and I think increasing concerns around inequality and tax justice is a key part of that. So the last thing is, what does that mean for the future? And so we're asking ourselves two questions, and these are, how can we improve the status quo? So the dominant fiscal regime that I described at the start, how can we improve it in design and implementation for resource-rich developing countries? So how can we improve interagency coordination? How can we simplify the existing tax system? So you might have, greater use of kind of publicly quoted mineral prices to calculate income. You might have rules on, how much interest you can deduct and so on. So what are the different ways that we can kind of make, the system that we have work better Secondly, and the question that I'm personally more interested in is, what are the alternatives? So yes, we can try and patch things up, and there's more that we can do on that front, and it does make a difference, and it does mean that governments collect more revenue now, which is really important. But there has to be a better way, and I think we have to really take stock of where we are and consider all these changes that are happening in the sector and society, and actually look at whether other alternatives, other alternative ways for governments to benefit financially. So, should we be looking to oil and gas to replicate the kind of production sharing models? Should governments be looking to just basically subcontract mining companies and pay them a fee for service, and in return keep all the cash flows from the project? Maybe there are other ways. Well, I have no doubt there are other ways as well. And so we're embarking on this process of trying to generate new ideas and crowdsource new ideas. And when we launch the call for ideas, we'll be sure to share the link with all of you in case you have thoughts or ideas that you want to share on this topic. So I'm going to stop there. I've talked for long enough, but hopefully it's been, an interesting, I guess, quick look through the past, the present, and the future of resource taxation and how that intersects with international tax issues as well. Thanks, Thomas. And Christian, back to both of you.
Thank you, Ali. And any comments, questions from the? Oh, here we have. Yeah, Ryan, you start because you wrote the seminar presentation for today.
Thank you for sharing your thoughts with us. So we were talking about alternative options, and I'm currently being taught by William Nordhaus, who wrote extensively about integrating the climate crisis inside macroeconomic models. And we've been talking about carbon pricing. So I wanted to import this idea to this discussion and see the correlation between a carbon tax and tax evasion, and how by placing the burden on multinationals, we could actually find a solution to both climate change and tax evasion. So my question to you would be, in what form or scale do you think we could have a carbon tax so that it is palatable and feasible to most countries?
Thanks, Ryan. Harrison, do you want to go next? I can see your hand up, and then I can address both your comments.
Sure. I mean, I think my question is probably a little bit different, but my question is to the last point on the slides about helping resource-rich countries maximize the revenue from their resources, and like that obviously raises the philosophical question of like whether we should, perhaps by contrast, help the world maximize the revenue of its resources rather than like the countries that were just luckily or actually unluckily endowed with those resources. So is there an alternative proposal around like a sort of global tax or global sort of I don't know, raising of tax or utilization of that I guess what I'm saying is somewhat clear. Yeah, thanks.
Thanks, Harrison. Thanks, Ryan. Yes, so carbon taxes. I mean, I think the last part of your comment, Ryan, about can we do this in a way that will be politically palatable and that multinational companies will comply with. I'm not sure if there's a good answer to that. I think that's a great question, and certainly carbon taxes or carbon pricing has to be an important element of the fiscal regime going forward, not least in relation to the extractive sector. I mean, oil and gas is, very clear there, but even so in mining, talking about coal, but also the carbon emissions that mining companies are responsible for in terms of the extraction process and processing and so on. We have to put a price on carbon, whether it's carbon pricing or carbon taxes. I think we also need to consider how the the tax system for mining and oil and gas can play a part in that as well, because it's one thing to have like a carbon tax, which puts the burden on consumers primarily, but there's another option. Well, in addition to that, I think we should also be considering how to price in externalities into the tax system that applies to mining and oil and gas companies at the production level. So in addition to trying to tackle this from a consumption perspective, also look at, what are kind of modern, efficient tax systems or fiscal regimes look like for the extractive sector that properly price in the externalities, because we just haven't really had that in the past. I look at, the number of countries that we work with that are coal producers, where that doesn't really factor into the fiscal regime, which is, for the most part, applies to all mining companies, whether you're producing copper or coal. And those are very different products in terms of their contribution to carbon emissions globally. And there has to be a way of, within the tax system itself, also incentivizing, I guess, the production of green minerals, or, the renewable energy minerals, versus kind of the minerals of the past, perhaps things like disincentivizing production of the minerals of the past, like coal. So I think there's options to also address it through the actual tax system on production as well. In Australia, I mean, we've had we're kind of pretty appalling really on these issues, but in particular the mining industry has been very vocal against carbon taxes, carbon pricing, and so, inevitably these issues are very difficult from a political standpoint, but provided there is some level of coordination and collective action, I'm sure we can get there. But I think developing countries are also looking at this very closely as a revenue raising opportunity post-COVID. So I think we will see perhaps more interest in some of these sorts of taxes, which is exciting. And I think that's where we also see the future of resource taxation. There's an opportunity, there's a moment in time, everyone knows that, for structural change. Harrison, to your point, well, I think Thomas has the answers to your question, because has written extensively on this idea. And I think it's a very interesting one, and one that would be good to actually try and incorporate into this broader kind of project around the future of resource taxation. Are we just talking about a tax system that benefits the host country that's fortunate, as you said, or unfortunate to have the resource? Or are we talking about something broader that seeks to kind of redistribute that wealth to other countries? And I think it's a very interesting idea. I mean, again, how you sell it politically, I guess, in terms of the idea that in many national constitutions, there's a kind of enshrined as publicly owned assets, and government is the steward of those assets. So kind of relinquishing some level of control over those assets, or contributing them towards the broader social good, I think would be challenging for people to engage with, but not impossible. And I think, Thomas is the expert on this. I don't have anything new to add in that area, but to say that I think it's very interesting. And I think, increasingly, even with things like automation, where we're seeing, all of us are going to be less employed in the future, or work less in the future. And so there has to be, stronger redistribution mechanisms to make sure that we all have enough, income to get by. You could argue that those sorts of ideas at the national level also apply at the global level, and then there's a need for redistribution at the global level. Francis, I can see your hand is up.
Yeah, good day, everyone. This is Francis Karugu, calling in from Nairobi. And I think my intervention is around the role of multinationals. Either those who are in the extractive sector, or those who are supporting the extractive sector, and the manner in which their behaviors and their pronouncements around their actions as far as taxes are concerned. Because if they're not paying requisite taxes from where they operate from, it's because they register companies in tax havens. Like in the case of East Africa and countries that are adjacent to East Africa, you'll find a lot of these multinationals registered in places like Mauritius, which is low tax jurisdictions. If that's not the case, then they are in collusion with state government officials. And my question is, based on those two situations, are there opportunities for policy and legislative interventions, especially from well-meaning governments in the West, to curb some of these multinational activities?
Thanks very much for your. Sorry, Thomas.
Enzo had a question also. She can take two at once. Enzo?
Yeah, it's basically similar. But before I go ahead, just thank you so much for taking your time this early in the day for you to come speak with us today. So my question is, how do we deal with the issue of multinationals that control both the mining aspect and commodity trading as well? And for me, it's like, well, this sort of like in trading by certain multinational groups allow them to pay lower corporate income taxes. So how do we do that in a way that benefits the states wherein they operate?
Thanks, Enzo. And thanks, Francis. So great questions. I think on the first question, well, I would say more countries should follow Kenya and rescind their tax treaties with Mauritius, which was, I think, a great step for Kenya, and Senegal has also done the same. I mean, I'm not saying that everyone should rush out and scratch their treaties with Mauritius, but certainly when you do have these sorts of treaties with low tax countries like Mauritius, you know perfectly well that mining companies in particular are going to structure their investments via Mauritius or whatever the other kind of relevant tax haven of choice is, or low tax country of choice. So we've actually, I do a lot of work with countries looking at their tax treaties and how they can design, if they're going to sign tax treaties, how to do that in a way that's going to better protect their right to tax their natural resources. But I think I think it's going to be very interesting to see what happens with the OECD digital tax project in relation to the global minimum effective tax rate, because if that does go forward and if the rate is set at a reasonable level, all of these are big kind of questions yet to be worked out. It is possible that tax havens finally have had their day and will become less relevant for investment, which would be great. And so I think that is possible, and that would be a great development if it does happen. I think otherwise, countries like the UK in particular that enable, support kind of a huge number of low tax countries within their territories and crown dependencies, that's a big issue, and certainly continuing to kind of draw attention to that, like Tax Justice Network and others do, is very important to really try and encourage these developed countries to take action. I think it's very difficult though, isn't it? Because countries like the UK are facing things like Brexit and COVID, and so the appetite to try and deal with issues of low tax countries in their kind of sphere of influence is probably quite low, because they also benefit from it. So it is a tricky one to crack, but that's where I think Pillar 2, the Digital Tax Project, might provide a way forward. I think more broadly, making sure that developing countries try and avoid signing tax treaties with low tax countries, that certainly where you see transactions with low tax countries, it's very clear that that's high risk, and that's what tax authorities should be focusing on. Yeah, beyond that, it's difficult, I think, but perhaps those are some ideas. In terms of, Enzo, your comment, which is an interesting one, because commodity trading in and of itself is a whole nother world, and I've talked more about the kind of traditional mining companies that extract and sell the resource, but you also have commodity tradings like Trafigura and Noble and Glencore and these companies that are, primarily trading houses. So they're just buying and selling. And they have a whole range of, separate issues in terms of lack of transparency. Often the deals that are struck between those trading companies and national oil companies in particular are very shady, very opaque, and I think the Extractive Industry Transparency Initiative is doing a really good job to try and shine light on that aspect of the sector where we don't know very much, and there's huge sums of money involved. But in terms of, I guess, the traditional mining houses and the trading that they engage in, that kind of integrated value chain that I described, or that example where you see kind of the sales to the related party and a sale to the third party. I think the types of measures that we're seeing countries put in place to deal with that risk is largely focused around using benchmark prices. So in the mining sector, a lot of the commodities that we're dealing with have publicly quoted prices. So I can go to the London Metals Exchange and tell you what the price of gold is this morning and this evening, and similarly for other minerals. So the benefit of those publicly quoted prices is that, one option is for countries to say, well, I'm going to use that to calculate your tax liability. I'm not going to, I'm not really interested in what your price is, the prices that you sell your product for to your related party. I'm just going to use the publicly quoted price, and then I'll make some adjustments potentially if there's a difference in quality and so forth, but limited adjustments, and then that's what I will use to calculate your taxable income. And that's one way of trying to get around that problem of kind of integrated companies that are selling the product within the group first and foremost. So I think quite a few countries do this in Latin America, but also in Africa and elsewhere, where you're just using a publicly quoted price, which is not, there are still challenges with that and adjustments that need to be made, but it might be preferable for governments than just accepting the realized sale price that the company reports. Another way is in the oil and gas sector, governments often come up with a price. So they set the government posted price for oil in Indonesia or Angola or Norway. And they do that by oil field based on the quality. So it's actually the government that sets the price rather than, which gives them kind of, very clear upper hand in that situation. So there's a few different options, but I think focusing on trying to limit the risk around underpricing is an important one, but actually some of the bigger issues are still around financing of mining projects, the high interest rates from related parties, the kind of marketing or hub structures that you see where, these hubs emerge in low tax countries again, to Francis's point, and their provision of intergroup services and so on. There's other kind of sources of base erosion and profit shifting that are significant as well.
Yeah, Ryan?
Thank you. So as a Mauritian, I guess I would be interested to hear more of your thoughts on the fiscal trajectory of the country. It would seem that in the absence of natural resources, the country has decided to instead become a tax haven. So would you have any recommendation on how to course correct? Yeah, thank you.
Thanks, Ryan. Apologies. I don't think everyone should tear up their tax treaties with your country. Yeah, I think it's difficult, and it's interesting because Singapore is another example, and one that's kind of closer to me right now, and certainly been, a very important jurisdiction, investment hub for mining in Australia, similar to Mauritius in Africa. And look, I think it is really difficult, and many kind of smaller countries like Mauritius and Singapore, the options are limited. And I know that Mauritius, I have our deputy director of the Intergovernmental Forum on Mining is Mauritian and used to be a trade negotiator for Mauritius. And I'm aware that, Mauritius is looking at various other strategies, whether it's financial services or so forth. And Singapore is a very successful example of this. I mean, that is a country that had very little was going on in Singapore 20 years ago, and then through very careful, targeted use of incentives, they have attracted mining companies and other large multinationals to base themselves there. Also because they have the advantage, the geographical advantage of being close to China, which is very helpful in terms of shipping and logistics and all those sorts of things. But I think Singapore, we often, when we talk about tax incentives, I'm generally not in favor of tax incentives in this sector in particular, but when we talk about Singapore, we have to say, well, actually, if you're going to do it, they've done it really well, very performance-based. So, they have entrepreneurial incentives that are about, number of jobs and activities, which is very carefully monitored. And there's an opportunity to basically claw back any tax that they would have otherwise collected if it had not been for the incentive, if they fall foul of those obligations. So I think Singapore is a pretty good model for how to be a kind of more responsible, I guess, investment hub. Beyond, that's all I have to say on this issue, but I'm sure there are lots of other ways that for countries like Mauritius to go forward, and I'm sure you have ideas as well. I certainly know it's not easy, but I think it's not just up to Mauritius, obviously. Often these kind of countries like Mauritius get caught in the crossfires here, it's really not about Mauritius as such, but it's more, these become kind of a proxy war as being fought in places like Mauritius and Singapore between, capital importing, capital exporting countries.
So if I can ask one more question, if you think of this as a kind of game where countries with significant mineral wealth are trying to maximize the revenues that they get, then I think you can think of it as falling into two components. One component is you want the market price, the world market price for your resource to be as high as possible. And the other is you want to capture as large a share of that price as possible for yourself. So on the first front, I think one intelligent strategy is to cartelize, right? To sort of work together with other countries that have the same resource and try to create some artificial scarcity, make sure that the market price is relatively high. On the other side, maximizing the share, obviously you will have to make allowances for the cost of extraction. But apart from that, the way one might go about it is to say, I will simply try to put the potential buyers in competition with each other through some sort of a auction or tendering process. And that way, many of the problems that you were discussing could be bypassed, right? It doesn't really matter. I wouldn't even tax these companies. I would simply say, how much money would you pay for the resource, and give the resource to the highest bidder or certain squares and say, you can have, you can mine in this particular area, and per ton of material that you extract, you pay me such and such a price. And the higher the bid, the more likely the person is, the company is to get the particular access to the resource. So do these ideas, are they being discussed? Are they promising in your mind, or what do you think?
I think cartelization is very interesting, and obviously we've had that in the oil sector, and it's worked very well for OPEC. And I mean, there's just enormous rent in the oil price because of OPEC and the power that they wield that you don't see in mining. So I think it's very effective. I think there have been moments where this has been explored in mining. So there was a similar group of producing countries for bauxite. Previously, for bauxite was relevant for the production of aluminium, and that kind of worked well for a while until certain countries sort of no longer saw it as being in their interest. Australia being one of them, and they kind of went off and did their own thing because I think they saw an opportunity to compete rather than they didn't necessarily. It's often the smaller countries that see the benefits of collaboration and coordination on these issues. So I think it's an interesting idea. I'd say it's not necessarily being discussed. I think it is worthy of discussion. I think the other challenge in mining is just the proliferation of different minerals. So whereas oil is very clear, you have a fairly standard product, in mining, maybe we might see in the future countries coming together around copper or other minerals that become increasingly strategic in a low carbon transition. So I think it's a possibility. I think in terms of basically, like auctions and lump sum payments, I think auctions, again, also a very interesting way of trying to maximize government revenues. I think the challenge has typically been around, information. And so, I mean, if you put something up for auction, you could just put it up and government doesn't necessarily need to know everything about the resource or about the costs to extract the resource. They just say, well, this is what it is. Whoever bids the highest gets the license. I think, the challenge is just around, you do need some information to be able to do that, and often developing countries haven't had that available to them. I think the other challenge, of course, is just how do you build in uncertainty, and if you auction something now based on the information that you have in terms of prices, how do you adjust for that over the longer term should prices change dramatically? I'm sure there's ways to do that. That's just a clause or condition of the auction, essentially. So I think both ideas are very interesting. Are they kind of getting airtime? Not enough, but that doesn't mean they shouldn't. And certainly, as part of this project where we're trying to generate new ideas, I think it's certainly they're certainly important ones. And we are seeing more countries move towards kind of competitive licensing. Afghanistan is an example where they have now competitive tenders for mineral resources. So I think we will see more and more of that, especially with the low carbon energy transition, and some of these minerals are just going to have already become hugely strategically important. And so states actually have potentially a lot more power, I think, to demand certain terms or run certain processes that perhaps they haven't in the past. State participation, state involvement in mining has just kind of declined. And it's basically because when they started to think about state participation, we then embarked on like a 30-year decline in prices, so it wasn't well timed, but I think that might change.
Okay, we are out of time, and we thank you very, very much for getting up
My
early
pleasure.
and giving us this very lucid talk. I hope I can do equally well, or at least half as well.
I'm sure you can.
Maybe
Thank
right.
you, Thomas. Thanks very much for the
Thanks,
invitation.
Andy.
Christian,
All the
nice to
best,
see you.
everyone.
Nice to meet you
See
all.
next Tuesday.
Take care of yourselves. Perfect. Take care.
Yes.
Bye.
Bye.